All right, welcome to the presentation. Um, right now, we're going to go over the S&P. We're trading up 0.59% today. You can see that we are approaching overbought levels going up. You can see we're at around 70 in the slow stochastics. So that's an indication that we're approaching overbought. You can see we're right in the middle of our channel lines when we draw our support levels. So we're in the middle of nowhere's land right now. And the biggest news today, if we go to the US Treasury, you can see the 10-year went down a lot today. It's been going down a lot all week long. And you can see that the inverse correlation has resumed. Whenever the rates go down, stocks very dependent on interest rates appreciate. So let's think of all the sectors of the stock market that go up. That go up whenever rates go down. First of all, any stock that borrows money that is heavily in debt has to refinance that debt. So that's an example of a kind of stock that goes up. Other stocks are home builders because it makes housing costs more affordable whenever the interest rates go down for um, mortgages. And you have small caps, you have anything that's high dividend is going to do well whenever the interest rates go down because it's going to be harder and harder to get a guaranteed return. So let's look at, with this in mind, we see the stock market in general is up today. Let's look at the main page of Yahoo Finance. Okay, it looks like um, stock market's doing good in all different sectors. Um, all right, so let's look at, okay, so the big picture here when we're looking at our meeting notes is next week we're going to have the Fed meeting and they're most likely going to reduce the interest rates by 25 basis points or 50. They don't know really. So that's going to be a big catalyst for the stock market, up or down. So a lot of times you have a big event like earnings or maybe the Fed talking or giving an update. You have a buy on the rumor, sell on the news. And sometimes it's sell on the rumor and buy on the news. So right now we can see that we're buying on the rumor. And whenever the rates come out and we're going to reduce interest rates, maybe we'll go down. So keep in mind that the stock market does the opposite of what you think it would usually. Um, and you have to think contrarian on a regular basis. Okay, so um, let's look at the other meeting notes. We're in September, which is one of the worst months of the year, but we're approaching some of the best months of the year in October, November, and December. So, um, so keep that in mind if you're monitoring whether to buy or not, or if you have some extra money to put into investments. Um, all right, so let's look at some more of our meeting notes. Okay, so we're basically done with earnings for this quarter. We had a CPI that came out, and we had a PPI that came out on Thursday. And basically, the inflation is going down. And we have a 2.5% inflation rate right now, which is pretty low. And that's putting a lot of pressure on the Fed to reduce the interest rates. we were predicting interest rate cuts on this month for like several months now, so that's been accurate. We actually have home demand returns, somewhere in the middle of March of next year, but actually we see now a lot of the home builders starting to get um, uh, appreciating in their price. So I guess home demand is kind of starting to return maybe this month because of the interest rate cuts. All right, so let's look at some more of our talking points. S&P is actually up 3 points, around 4% from last week. So we had a huge down week last week, and that was down like 5% and 4 or 5%. This week we're up 3.6%. So we basically gained everything we lost the week before. And you can see that the treasuries are continuing to go down. That's in general helping the stock market because lower interest rates allow companies to buy, um, invest at a less expensive financing cost. All right, so the 68% of the S&P is above the 50-day moving average and 69% above the 200-day moving average. So we're gaining just a little bit of momentum from last week. Our reversion to the mean that we talked about from the beginning of the year is coming true. Well, utilities are really starting to outperform. They're up 20+% this year. And a lot of the stocks that are going to be paying dividends, such as healthcare and telecom, are going to be in vogue because the interest rates, the treasury rates, the guaranteed safety investment are going down. So there's a lot of investors looking to um, get a high yield, and that's where you find it in healthcare, telecom, financials, energy, and utilities. Energy has been the worst performer this year. Let me see. So that didn't match our prediction at the beginning of the year. And all right, so let's look at some more of our talking points. Okay, so we're seeing the S&P is approaching overbought status. So we have a little bit more to go before we're at the top of this channel. So we're in the middle of the right dab in the middle of the two channels. So it could basically go up or down, but when we have the Fed talking next Wednesday, that's going to be, we're going to basically go sideways until that meeting, and then it'll go up or down based on what they're saying. We still have, we have a um, inverse correlation between the S&P and the yield of the 10-year Treasury. You can see that we had a 100% correlation whenever there was the yen carry trade. We'll talk about that next. On August 5th, we had what's called a yen carry trade. The stock market went down like 5 or 10% in some instances. And that caused a sell-off in a lot of the biggest stocks in the stock market. Let's look at some of the variables in the stock market. We have oil is super down. It is trading at $69 a barrel. That usually indicates either a slowing of the global economy or there is increase in production by members of the oil community. Inflation went down 0.5% since last week. It's currently at 2.5%. It was 2.9%. So that's going to help the stocks because the interest rates will be going down and as the inflation goes down. US dollar index is unchanged, but it's been going down recently. And that's all there is to say on our variables. The dollar index the dollar is continuing to slide. And the one thing that's important about this is the yen is appreciating, and that could cause volatility in stocks in the next month or so. Let's look at the fear greed index. it was fear and extreme fear the last 2 weeks, and now we're getting back to neutral. So we don't really, like I was saying at the top of the talk, we're like right in the middle of the overbought and oversold, and right in the middle of our channel lines in the S&P. So there's no action to take, if you're thinking about buying something right now. Um, Basically, whenever people are at extreme fear, that's when you want to start looking to buy things. In extreme greed, that's when you want to look to sell some things, if you're in that mindset. We're getting less bullish in the AAII sentiment indicator. So you can see that we were up right at 50%. Then we went to 45%. Now we're at 39%. We're approaching bearish level where it's almost even bullish and bearish. So that's interesting. I wonder what it'll take for the AAII individual investors to become bearish. I don't know. Maybe a recession. Let's look at the VIX. The VIX is 17. 17 is it's pretty low. That means people aren't afraid. They're not buying protection, and it's green light to buy stocks. Okay, so we're basically at a return to normal stage. We're not in a fearful or a capitulation feel in the stock market. We don't have any of these major items that may lead to a crash. We did have a debate, and the debate basically indicated that Trump is not going to win, uh, or the odds went in the favor of Kamala Harris to win. So there's a little bit more certainty. So I guess what people are thinking right now is we're going back to normal. Pretty soon there's going to be media attention, and we'll be in this phase here. So I think maybe we were at this right return to normal. Then we're going to back to media attention. The reason why I go over this every week, is whenever the typical investor is in despair mode, that's the time you want to look to buy things, not to sell. So if you're still starting out investing, normally the normal way to investors allocate money is when things are going up, they keep buying more. And when they're delusional, there's greed, there's public enthusiasm. That's whenever people buy. But whenever there's capitulation and there's sales in the stocks, people don't want to buy. So Walter Deemer says, when the time comes to buy, you won't want to. And that's exactly what this despair is. When people are thinking in the middle of the COVID crisis, this will never end. This is the end of all stocks, and it'll go lower. That's just the time you want to buy. So that's good to know. Let's look at let's look at some of the sector performance from this year. You can see that after the last week of action, the technology sector went back up, but the utility sector is up 21% this year. That is pretty amazing. Communication sector is up 19%, and the financials and S&P are both up 17%. So if we go back to our worst to first, you can see that the healthcare, energy, consumer staples, and utilities were all down last year. And this year, all those sectors except for energy are outperforming. So energy and consumer discretionary are the worst, and materials are the worst sectors this year. With energy, you're pretty much at the mercy of the price of energy. So right now, the price of oil is down to $69 a barrel. That affects a good number of the stocks in the energy sector. And it's surprising with all the geopolitical tension that it's down so much, but when you're investing in energy, even though you have the best run company, sometimes you're at the mercy of the price of the underlying commodity. And that's why I basically don't have a whole lot allocated to that sector. Um, but I do have, that Exxon is one of my biggest holdings, so I'm never going to sell that. Um, all right, so let's look at our themes for this year. Themes are AI revolution, disruption, build out the data center, um, demand for electricity, cyber security in the grid, and utilities such as electric companies increasing demand. All right, so and the weight loss drugs. So these are all the themes that are turning out to be winners this year. Um, Healthcare and utilities and consumer staples. The investors will be reaching for yield as the interest rates go down. So the telecom companies, the companies that are paying 5 to 10%, 8% in dividends are going to be in high demand as interest rates go down. All right. And that's turning out to be true. These sectors like the Verizon and AT&T and Altria, they're all appreciating now. All right, let's look at the sectors that are sector ETFs that are going up and down. Okay, the interest rate, the big picture here is the interest rates for the US 10-year Treasury have gone down a lot today. This is 0.034 is a lot. And you can see it's going down a straight line. Um, and let's look at these sectors that are going up and down today. I would think home builders. Okay, that's right. Home builders are directly affected to the interest rates. As interest rates go down, the mortgage affordability improves. I'm not sure why gold miners are up. Home construction, we just went over that. Metals and mining. Let me see. Regional bank, okay, banking, whenever interest rates go down, that helps the banks. A lot of banks have um, bond portfolio. Banks and insurance companies have bond portfolios. And whenever the interest rates go down, that helps the bond appreciate, and that affects their bottom line. We have the banking, we have semiconductors going up today. We have the telecoms that they pay high dividends. So that makes sense why they're going up today. And biotech, these are um, these are companies that need to borrow money because they're small companies. And as interest rates go down, that makes them more profitable. In utilities, okay, again, that was one of the best performing sectors this year. They're continuing to go up. Let's look at the ones that aren't going up as much. Oil, and healthcare and financial. Okay, so it looks like we have interest rate sensitive sectors going up. That's no surprise. Now let's look at the actual stocks that are going up and down. We see Adobe, they came out with earnings. We'll go over them later on today. They're down 9%. Um, they're pretty much overvalued. We've been saying that for a while. We'll talk about them later. Let's look at Warner Brothers Discovery. They're heavily indebted right now. Caesars, they borrowed money during the pandemic to survive, and a lot of these companies have lot huge debt that they have to pay off. Walgreens, they have a lot of debt to pay off. Let's look at that just for fun. This is an example of a stock that borrowed heavily to get where they are. Let's look at Walgreens. I'm surprised WBA. Okay, Walgreens Boot Alliance. What we're looking at right now is the debt level on this company. It's extremely high. As interest rates go down, this stock would go up. Total debt, 130, wait, it's 33 billion, maybe with cash of 1 billion. Yeah, it's around 33 billion in debt. Their market cap, 7.6 billion. I don't know how this company stays in business, really. There's a really fine margin. They're not making money with every one of their profit margin is -4. Return on equity is -55. So this company pays a lot of money to service this debt. So this is an example of a company that could go out of business. Um, it's very, very dangerous to invest in this company. Um, but this is an example as interest rates go down, this company, if we had a zero rate interest rate environment again, this stock will go up a lot, but it's very dangerous. They could go out of business any day. And they're not growing that much either. And they have a lot of competition from um, cost plus drugs. I mean, they're eliminating the middleman of the pharmacy. There's Amazon getting into the pharmacy business. This is like a super dangerous stock to be in. Let's look at the chart on this stock. My guess is it's going downhill. I haven't looked at it in a long time. Let's look at the max. Okay, let's look at the full screen. So whenever it's going up 5%, when it's down so much, it's called a dead cat bounce. So dead cat bounce is whenever a stock could be going out of business, and then you have so many companies shorting the stock that a little bit of good news would make it go up, a lot. So I guess the good thing about the stock is it pays a dividend, but it's extremely affected by interest rates, and they just have a lot of competition. They're one of the oldest companies in the stock market. They're like 100 years old or so, but they might not be I think they have a lot of problems with theft and shrinkage. There's a lot of challenges for these kind of companies. Um, so let's look at, okay, we're looking at the um, chart of Walgreens. It's taking a while to pull this up. Okay, wow, look at that. Right around 2016, it was, it's just been in a downward spiral. They're going to go bankrupt, it looks like. Okay, that's very dangerous stock. Okay, so sector, let's look at okay, so that's going up a lot today. So you can see a lot of these companies that are borrowing heavily are going up. Oh, look at this. Uber Technologies up 5%. There's a news story today that Google and Waymo are allowing Uber to implement self-driving in different cities. That's going to help them a lot. We'll go over Uber a little bit later on. So let's see. All right. That's all I have to say for that. Let's go to our talking points. Okay, so let's look at Dan Now's picks from the beginning of the year. Amazon is up 23% this year. Meta is up 48%. Texas Instrument, 15%. XBI up 10%. And KWeb, -4. Okay, he's been doing pretty good, but Meta's been the outperformer. He said they're going to be doing good with the political spend for the election. And Amazon continues to do well with AI, data center, and improving their distribution network for their retail operations. Okay, let's look at, here's a little story. It says, carry trade unwind could replicate August mayhem, suggests currency strategist. Okay, so basically, we were wondering whenever the 10-year treasury was going down and the stock market was going down at the same time. That didn't make a whole lot of sense to us. So let's look at that chart again. We had an inverse correlation for the longest time. Hold on, we're getting there. Okay, we had an inverse correlation. You see this this is the S&P, it's going up, and this is the 10-year treasury going down. But this little area here, we had that yen carry trade where interest rates went down right here, and then the stock market went down with it. And it looks like the reason for that could have been this unwind of the yen carry trade. So the dollar is going down and the yen is appreciating. So what this is a chart of the NASDAQ and the yen and the dollar. So as the yen appreciates and as the dollar depreciates, that presses a lot of people to sell the top tech stocks. And so what that means is if the stock market crashes 10 or 20% someday, it could be because of this. Companies unwinding this yen carry trade. If that happens, then don't sell because it's only temporary. It's not the underlying, it's not the stocks. There's nothing wrong with the stocks. It's just volatility because of someone made a bad trade. So we'll revisit this if we ever have a 5 to 10% or 20% crash between now and the end of the year. And we'll see if this chart, the yen dollar, which is the red, and the NASDAQ, which is the blue, are inverse correlations. And that'll basically prove that the stock market went down for no good reason other than a couple traders made a bad trade, borrowing money from that they didn't expect this yen carry this situation to happen. All right, so okay, so this is Ed Yardini. He said that this doesn't make sense. Why are the stock prices falling when the Fed is set to cut interest rates? But he was saying it's probably because of this inverse correlation between the yen and the NASDAQ 100. And we're going to follow this yen NASDAQ 100 correlation, see where that goes. And this is a theory. We're just going to the great thing about making theories like this for ourselves is if the stock market does crash and we do see this correlation, this inverse correlation, then we know this is the reason why it's happening, and we can take advantage of these hedge funds that have to sell quality stocks. All right, so here's some charts I thought were interesting. We have Google. It's in an uptrend right now, starting from 2 years ago, basically. But you can see that they've been going down in this little tight range. But they had some really good news today. Waymo is working with Uber to deploy robo-taxis across the United States. So that is pretty huge. That is unexpected. A lot of people didn't see that coming. And so I think it's going to be a couple years for this litigation about the monopoly of Google to come to fruition. So looks like Google's going to be making 14% appreciation for the next couple of years until that's resolved. So the other things, here's Boeing. They had some really bad news this week. They had a strike in the Seattle area, and that's going to affect their output for their planes. So they have a lot of problems. We already said that they have quality control problems. They can't make enough planes without defects, and we have headline risk every month or two. We have there's a plane malfunctioned and needs to be recalled, or there's a crash. It just like there's a lot of warts. There's a lot of problems with this company. Whenever you see a chart going down like that, it's just you stay away. It's not reliable. Speaking of unreliable, the earnings estimates for this company are continuing to go down. They're unreliable. They have negative earnings. So this is an example of a stock that isn't consistent. It's really hard to buy and hold this stock for 20 years because you don't know what's going to happen next, and you don't want to be owning a stock that doesn't have a whole lot of reliability. Okay, let's look at the next stock. Oh, okay. This is that article. Boeing workers overwhelmingly reject contract, prepare to strike. So they have union issues. They have considerable amount of debt, inconsistent earnings, unreliable business model. Um, it's a good example of a stock to avoid. Boeing's earnings. Look at all this negative. It's just it's supposed to like double their earnings. Look at that. That is like an amazing recovery. But is that reliable? Do you think we can count on that? I don't think so. I think there's going to be something else that comes up. It's just not something you can count on. So whenever I see red and there's no real good um, pattern or explanation for it, I try to stay away from that. You can see that their PEG ratio is 6 and forward PE is 38. They're not growing. They haven't been growing for the past couple of years. They have negative profit margins, no return on equity. And well, for a $100 billion company, half of their half of their market cap is in debt. So 57 billion in debt. No, I guess net of the cash, they have 40 billion in debt, which is a lot. So this company has a lot of problems. I guess whenever interest rates go down, they're going to be helped a little bit on that debt. I just don't want to be involved with this. It has too many warts. Okay, let's look at NVIDIA. NVIDIA's example of a stock, um, they're very volatile. So whenever you buy this stock, you have to be willing to sit through a washing machine of emotions. Um, it looks like they're growing at 30% a year, at least. And there are news stories every day that um, there's not going to be continuous spending on what they sell. But it looks like they're in an uptrend. Looks like they're growing around 30% a year. Um, they're basically this green line right here is the 150-day moving average. This has been super good support for the stock. Whenever it goes back down to here, this 150-day moving average, that's then if you see it there, that's a good time to start looking to buy it. And let me see. All right, so that was okay. I had another article on it says people are leaning back into big tech ahead of the election. It says Altimeter's Brad Gerstner. He was talking about its portfolio in this video. NVIDIA is the most important company in compute today. It's now his biggest holding, he said. And there's going to be a huge replacement of CPUs in data centers, trillions of dollars of CPU replacement. For every dollar invested in by the hyperscalers, they'll get back $5. So right now, there's a lot of focus on, are these companies like Google, Microsoft, and Facebook going to get their money back after all this investment in AI? And that's the big question. We haven't seen a whole lot of return on investment yet, but we do see isolated companies that say that AI has helped their companies. So let's look at Altimeter's Brad Gerstner and what his top holdings are for Altimeter Capital. You can see that we had Snow, Meta. I chose Uber to look at because we've already looked at a lot of these already. Uber is 15% of this guy's portfolio, which is really big. So he must really believe in that story. Let's look at Uber. Uber is the stock that they do food delivery and they do they do taxi, personal driven taxis. So their biggest costs are the people driving the vehicles. What they did in a news story today is they said they're eliminating the people driving the vehicles, and they're introducing Waymo's driverless rides in a couple cities. So that's going to improve their margins. And that, I guess Brad saw that as a possible opportunity. Let's look at Uber's. You can see that they had a lot of losses here, but you can see that progressively they're going to be growing probably around 40% from this year to next year. They said they're doubling their earnings, and then after that, 40%, and then 20%. So maybe if you average it all out, they're going at 40%. Their PE right now is 28. So that means, I didn't do this math right. I usually do it right. Okay. So if you divide, so if their P is 28, 28 divided by 40, the PEG ratio is 0.7. So they're 30% undervalued. I like to look at a stock like this and wait for it crash. And because these stocks are very volatile, if you have a rather high PE ratio. So you can see that the August 5th crash, they went down to $60 a share. That's like 15% lower than now. So, so if you trace these bottom lines here to this right here, this here, right here, they'll probably go down to here again. So I'll be looking to maybe buy that. Looks like a pretty decent stock. And I like stocks that are automating the majority of their business and reducing expenses. So if you look at their market cap, it's 143 billion. Um, return on equity is 20%, which is really good, 19%. Profit margin is 5%. Both of these will go up as the robo-taxis are deployed. So we can watch these profitabilities go up over time. Okay, Adobe came out with an earnings report yesterday. They went down 10% today. What we're going to do is they said they delivered an outlook that failed to quell investors' impatience. Okay, we're going to look at their stock. They're a $260 billion company, so they're really big. Their debt, they have net cash of 2 billion, so that they don't have a problem with borrowing money. Their return on equity is excellent at 34, and their profit margin is 24. The only problem is they're expensive. Their PEG ratio is 2. So let's look at their earnings projections. It doesn't look that great. They're growing at like 13%, and the PE ratio is 28. So they're 2 times overvalued. So in a stock market crash, they would go down to 272, their fair value. That's the only time I would look at buying something like this. The problem with this company is there are free AI tools such as ChatGPT, where you tell ChatGPT, clean up this photo or draw me a cat driving a car. And why do you need Adobe software if you have something like that? So they could be in a process of being disrupted. They're trying to add AI to their offerings, but it doesn't seem like with this report yesterday that they're actually countering that competition. All right, so sometimes when an AI stock goes down, it brings down other companies in the sector. All right, so that's what I had to say for today. I hope you had a good week in investing, and I hope next week is good for you also. All right, well, see you next time.